Hey everybody, this is Mark Smith from Digital Roughnecks, and I'm here with Arooshi from Orin now. Welcome, Arooshi.
Hey Mark, I'm so excited to be here.
A lot has happened since the last time we spoke, and so I thought it'd be really good to get the audience up to speed on the SEC's new climate rule. I mean, the last time it was just in draft, but now it looks like it's moving ahead, notwithstanding the lawsuits that are happening from some of the red states, but it's moving along far enough to where we can see that it's going to happen. And number two, you work a lot with international companies who have already approved their climate reporting rules. And, since we live in a very global international world, I think it would be great insight to hear what's happening outside of the US and kind of giving you a crystal ball on what you think is going to happen here. Welcome.
Yeah, thank you so much. I've put together a presentation. I'll start walking you through this.
Okay.
So first things first, I just want to talk about what the SEC's climate rule really is about. It took us about 2 years to get here, right? I believe the first proposal, the first draft was passed roughly 2 years ago. And after lots of back and forth, lots of feedback from both sides of the government, feedback from lots of corporates, we have a final regulation that's out. This regulation is and again, with like most things US, it's kind of investor focused, right? And here are some key components of this rule. Number one, of course, is companies will have to disclose their scope 1 and scope 2 greenhouse gas emissions. What this means is that so when companies are accounting for their greenhouse gas emissions, they have three scopes. There's scope 1, scope 2, and scope 3. Scope 1 is basically direct emissions, which is and direct emissions that take place within a company's boundaries, right? Like a company is using maybe natural gas to run their machinery, maybe using petrol to use to kind of run the trucks that they own, maybe using coal for certain boilers, so on and so forth, right? All of that accounts for their scope 1. Scope 2 emissions are basically indirect emissions, but the ones that still take place within their boundaries. And this is purchased electricity and cooling, right? So companies will have to start quantifying their emissions based on these parameters and start reporting it. Next, and something which is super important, is another material climate risks. Material climate related risks, right? What the word material typically means is that if an investor was looking at this data, would this inform their investment decision or their voting decision? So that's like the technical meaning of the word material. And companies have to disclose what are the climate related risks to their operations, right? We see a lot of wildfires happening in California, right? How does that impact your business? If you have business or operations in a flood prone state or a location, how does that impact your business? So that has to be put out. And of course, if you're kind of disclosing these climate related risks, you also have to talk about the activities that you take up to mitigate these risks. In addition to that, the SEC also wants you to talk about what is your board of directors oversight on the risks that we mentioned, and how is the management playing a role in managing and mitigating these risks. And last but not the least is if you have any climate related targets and goals put in place, covering your entire business. So this is pretty much what the rule wants these companies to disclose. Moving on, certain key features of this entire rule, right? I already talked about that scope 1 and scope 2 emissions. What's really funny, right, is that any company, right? If you say, I'll take the example of a manufacturing company, about 70 to 80% of their emissions actually lies in something that's not required to be reported, which is their scope 3, right? And scope 3 today has like 15 categories. This is the goods and services that you purchase, how your suppliers, the emissions from your suppliers, the emissions from your employees, the emissions when your customers utilize or use your products. So that has been kind of kept out, and this is something that's got a lot of interesting negative feedback for because this is one of the most important aspects of emissions. So this was quite interesting. In addition to that, companies only have to disclose the material issues that are financially material, right? The SEC has kind of tried to make this rule very investor friendly, investor forward. So financially material climate risks are the only ones that have to be disclosed. In addition to that, right, we talked about these climate risks. Now, these risks tend to have financial impact on business, right? We talked about the wildfire, we talked about the floods, right? So if any of these risks have a greater than 1% of impact on your profit, has an impact that is more than 1% of your profit before tax, you do have to disclose that impact as well, right? Then and I think Mark, you mentioned, right, that, and we talked a lot about this in the previous podcast as well. Today, the big problem with the space of climate reporting and the space of sustainability reporting is that all countries across the world have a different regulation. It's called something else, and it's evolving in its own independent way, right? Europe, right? Like Europe is one of the leaders when it comes to sustainability reporting. They have something called CSRD, right? Any company that has investors in Europe or has customers in Europe do have to comply with some of those laws. We were just talking about CBAM, right? The carbon border adjustment mechanism, right? And any company that's kind of exporting to Europe has to keep that tariff in mind when they're selling, right? So yes, similarly, even the SEC rule has something called TCFD as its backbone, right? TCFD now has so lots of acronyms here, right? But yeah, there's something called TCFD, and which has now been absorbed by another body called the ISSB. So that's that. And last but not the least is that companies will have to start would be expected to have their first report out at the end of the financial year of 2025, which is they'll have to have their report out in 2026. Yeah. So before we move on to who gets impacted, Mark, any questions for me?
Um, no, I mean, I think you kind of nailed it on the number four, where, when they're talking about the influence of some of the other, like you have clients, for example, in different countries like India or Hong Kong. Like, tell me some of those countries that you already have clients in, and kind of how far along they are in terms of, implementing these rules in their own country.
Yeah. What I find really interesting is that the United States is one of the last major economies, or just economies in general, to have such a rule in place. Right. Today we have customers in India, Singapore, Middle East, Europe, and all of these countries are much further ahead on their sustainability journey than the United States. Right. Like we need to have the first report out in the financial year of 2026. I mean, we do a lot of work with companies in India, right? And India, like this financial year is the second year of this being reported. And again, same with Singapore. Like Singapore is also kind of they're just tightening their rules there. The Middle East also, they don't really have very stringent rule in place, but the Middle East is really trying to kind of rebrand themselves slightly, out of oil and gas, and into a more sustainability focused region, right? They want to invite more business, they want to invite more other industries beyond oil and gas as well. So sustainability is a very core part of again that entire vision, right? I believe last year was something called the Year of Sustainability. They hosted the COP28 there, and they've also expanded this year to also be the Year of Sustainability. I was actually there in January, and it's fascinating, right? Like, you'll have these advertisements from real estate companies, and they kind of really talk about sustainability quite a bit, a little too much sometimes, but still, it's still there, right? So that's interesting. And again, I didn't mention Europe, but I think I don't have to mention Europe in this case. Like Europe has been leading all these other geographies by multiple years, 8 to 10 years, right? And again, we work with customers there, and those are some of the most stringent laws, and also laws against Again, even the slightest hint of greenwashing could cost the company a lot of money in fines and reputation damage, and then sometimes even losing license. So yeah, it's
Well, in fact, I saw, it's probably been a year ago, that I think even a CFO in Europe was arrested for greenwashing, right? I
yeah.
mean, like you can go to jail for greenwashing. I mean, it's like it's equal weight when you're doing your financial reporting for a public company. You have your financial forward looking, and then you have your climate forward looking. And so, for my audience, who a lot of them are in charge of their emissions data, it's taking on a weight that they've never had to deal with before. I mean, this is the first year, I think, that where if you are an HSE person, you're being called in by the CEO and said, "Hey, what's my methane tax liability, or what's called a waste emission charge?" Like, what? They've never had to report a number like that before, and so now they're being baptized into this regulatory reporting kind of world, and so getting this emissions data figured out is happening in the U.S. in a real hurry. So anyway, yeah, let's keep going.
Yeah. On to the next question, which is who does this rule impact? And pretty much all publicly listed companies, right? And also, I think the SEC has also planned on having on like a phased out approach in terms of the implementation. They're targeting the large accelerated filers first, and again these are the largest companies in the countries, and then these other companies kind of follow under their guidance or something like that, right? Then in addition to that, and I think we'll talk about this later as well, like irrespective, right? Companies should start taking action today, right? Because even though the SEC law is something that comes out in, it will become relevant for you in 2025, 2026, you still might have customers in Europe, right? So CSRD is something that becomes relevant to you. You still might have employees or customers or business in California. So that becomes very relevant to you, right? So company should start having this, just the basic accounting of their scope 1, scope 2 emissions in place, and of course, quantifying their climate risks, doing their methane intensity calculations to kind of really, so that they're not left, that oh, suddenly one day they wake up and like, oh, how am I going to bring all of this data together, right? So that's something that's super important. And Mark, this has been really funny, right? Like the response so far has been very, very interesting. So the SEC has been, so certain states in the US have sued the SEC, right? Calling this rule obnoxious and just just unnecessary, and accusing SEC that this, like a regulation like this would slow down business. So that's on one side, and on the other side, you have not-for-profits like the Sierra Club, who are kind of saying that this is not stringent enough. And there are lots of these climate activists and other folks in the sustainability industry who are kind of saying that scope 3 is something that should be included, right? And again, rightly so, right? Like 70 plus percentage of a company's emission lies in their scope 3, right? So it's a little, I mean, the companies can hide behind that their scope 1, scope 2, which is very less data. So this has been quite interesting. I think bringing back how companies can prepare, right? And I think we briefly talked about this, that the SEC law is not the only one, right? It's one of the last to come into the market as well, and it's definitely not the only one, right? Any company that's selling to Europe, and again, I'm sure you might already be familiar with these concepts, right? And also, what's very interesting is that the SEC rule focuses only on climate aspects, right? What that means is that the GHG emissions and the climate related risks, right? However, CSRD goes deeper into certain other ESG parameters as well. They want you to report on topics like human rights, anti-bribery and anti-corruption, right? And a couple other social biodiversity is becoming very important, right? So CSRD is a lot wider compared to compared to the SEC rule, the SEC rule. Even the California regulation, like I've mentioned scope 3 multiple times, the California regulation also requires companies to report on scope 1, scope 2, and scope 3. Again, if it is material to them, but yes, they have to report on scope 3. And of course, the climate related risks also definitely have to be there. What's also interesting is that the California law is not only applicable to publicly listed companies, even private companies that are doing business in California, or again, there are rules. Happy to kind of share the links with you, Mark, so that you could share it with your audience. But if you have certain number of employees or certain number of revenue coming from California, irrespective of you being a public company, private company, or a company that's kind of maybe headquartered in India, right? But if you still have employees in California, you do have to report on these parameters.
So if you were, I don't know, based in Colorado, you're producing nat gas in Wyoming, but all of it is shipped to California. That last little part then says, oh, guess what? You're making you're actually your buyers in California. Therefore, you're subject to the California reporting rules. Is that correct?
That is correct, yes. And like I said, right, this one goes a lot deeper. It's a very California way of doing things. And it's like, I think the reason I smile every time I talk about scope 3 is because we do a lot of work in this accounting, right? And think about it, right? And like, I would urge your listeners to think about how many suppliers do they have all in all, right? And again, this number is definitely more than 1,000, right? And you have to now to get to quantify your scope 3 data, they will have to engage these suppliers and get their scope 1, scope 2 data, right? And again, for you, it's so hard to quantify your scope 1 and scope 2 emissions. Imagine for some of these suppliers, right? And they're not happy about it, right? So it's a really hard part, and that's just one part of it. There are 15 different categories, right? So scope 3 is just really messy, and if you're doing business in California, that becomes very important.
Wow. Okay.
Yeah. Moving on, right?
Yeah.
And again, the last piece is that yes, we've kind of talked about that. Yes, companies should prepare for this, but how should they prepare for something like this, right? Of course, doing accounting for your you're just starting today. Start accounting for your scope 1 and scope 2, right? Again, scope 3, depending on where you sell, where you have your customers, where you have your employees, etc. One thing that you should be mindful of is that this emissions data is subject to assurance, right? What that means is that if you're kind of putting out a number that, oh, my scope 1 emissions is 500K ton CO2, right? Just a random number. You do have to get that data assured by a third party audit or assurance organization to prove that to prove your methodology and the emission factors that you've taken. And again, here using sensor data becomes really important, right? Because that's one of the most accurate ways of capturing data. So your auditor might also want to look at certain just reports in that regard. You can start quantifying your climate related risks. There are lots of these publicly available databases that you can look into, right? Start looking at that, see how these risks impact your company, your business, your top line and your bottom line, right? And of course, you also have to start quantifying that, okay, disclosure of your expenses and losses pertaining to these climate risks, your disclosure on capitalized costs and charges, again, pertaining to these climate related risks. And of course, if you've purchased any carbon offsets or RECs, even that has to be talked about.
All right.
So, yeah, that's pretty much it from my end. Yeah, it
And
seems simple,
so tell me more about your company and how you help clients deal with all this stuff.
yeah. So Mark, we work with companies across the world, right? And again, what we've seen is that today we live in a globalized world, and almost every large organization does have some form of operations in the form of of their own operations, their manufacturing plant, or their customers in one part of the world, which is outside where they're kind of headquartered, right? So we work with companies, we act like their outsourced sustainability team, right? And any kind of sustainability requirement they might have, right? And what we've seen is, right, that there are three key stakeholders that care about a company's sustainability data. One, of course, is regulators. Secondly, investors. We do work with companies that are the portfolio companies of Blackstone, Carlyle, etc. And all of these private equity firms have fund level sustainability goals, which then kind of trickles down to all of their portfolio companies, and they're really really stringent and serious about it, right? With these companies, we have to do quarterly reporting to these private equity investors, right? So that's the second stakeholder. And third, and which is one of the most important stakeholders, is customer, right? Today, on almost every large organization, like the globally top 1,000 companies, if you look at them, right, like Pfizer, Novartis, Johnson and Johnson, BMW, etc. Think of any of these companies. All of them have very stringent supply chain sustainability requirements, right? Which means that they require certain disclosures out of their tier one, and then tier two, and then tier three suppliers, right? We already talked about that scope 3 component. Beyond that, right, what are the human rights policies like? You mentioned that you have a lot of EHS folks listening in here. EHS is a very very important part of sustainability, right? So those disclosures have to be put out to these customers, right? So we kind of work with corporates, and we built a platform that handles all of this data. It's like their single ERP for everything sustainability data. So we kind of give them that, and of course we have lots of, like, we provide services and consulting to help companies improve this data, right? To kind of build their ESG committees, build again, help their board of directors articulate their strategy around managing some of these risks, and building checks and balances around that.
Excellent. Well, hey, this has been a great update, and I really, really appreciate it. I'm going to put, all your contact information along, in the show notes for this particular video podcast, and whether it be available online on our blog and YouTube and so forth. So anyway, I appreciate you coming on and give us an update, and I invite you back anytime there's any kind of major update to this, like when it gets published, or how you're walking people through this. I really appreciate it.
Absolutely. Thank you so much. Thank you so much for having me.
All right.